Hey guys, today I'm going to show you kind of inside the mind of institutional traders and how they take our money. Um, this is a price action strategy, and if you can master this, it's a good way to trade. So I'm going to start with the first two here, and these are called fakie patterns, and it's what institutional, your banks and this is how they trade. So here we have an outside bar and an inside bar. Um, Basically, what you're looking for is your outside bar to be from open to close, or not open to close, but top high to low of that candle. You're looking for the next one to be within the the high and the low. So you can see here the high, and this high is lower, the low, and this low is lower. So price moved up, um, we get a smaller candle, and then this is the fake breakout. So what happens is uh, the everyday trader starts seeing this bar and it breaks out above the previous high, and they go long. And this is what triggers the banks to short. So um, as it gets up here, this is where the banks start shorting. And boom, the bank's goal is to take out and liquefy your trade. So they're looking to force you into your stop loss and take your money. So everybody's thinking long here. You can see traders are going long, and then boom, the banks start shorting. So from there, I would expect this to keep going. Same thing here with a bullish fake. You've got your outside bar, inside bar. Um, what happens is when the price breaks below those, everybody starts selling, and then the banks come in and boom, they start buying. So that's the general idea. And now I want to show you a little bit on the charts. Again, if you can master this, it's gonna seem very foreign at first, especially when you're going against the trend. It's kind of taking what you know and flipping it upside down. So when you're thinking long, um, banks are thinking short, and that feels very funny. So let's look at right here first. Get rid of that. So first thing I'm looking for is an outside bar, inside bar, which we have right here. We have the high, the low. Let's zoom in a little bit. Okay. Even right here, you have your high, or your low and your high, and this one here is an inside bar, and it's smaller than that one, basically. So here, what you get is this candle closes here and moves straight over. Once it passes this high, especially since we're in an uptrend, once this passes, the normal trader says, okay, I'm going to buy this trend up because it makes sense. Um, and this is your fake breakout. And then this is where things start coming down and hitting people's stop losses. Now you're at entry of this trade, or your stop loss, depending on where you take your setup, and boom, falls back down. And then most likely from here, this is where traders see this drop, and then they start selling, and then boom, the institutional buyers start buying. So here we've got another one. We've got a low and a high, and then this candle in between. So what we're looking at is this candle. Keeping in mind we're in an uptrend. This candle closes right here. The next one opens, shoots past up there, fake breakout. Really, I wouldn't have traded this one because I'm looking mostly for the long wicks. Price continues down, following the previous candle, which is bearish, down here, and this is where the banks come in and buy, and they bought heavy right here. I know that's confusing, but let's keep with that. The banks are buying heavy, heavy, heavy. We're up here towards resistance. People are still in this long. They've switched their trades roughly here, and they're going long. The banks see resistance, and probably a lot of day traders see it as well, which drops this hard. So we have another outside bar. Next one is in between. Price shoots back up. People start buying again, and boom, the banks start shorting. We come over here. Let's move on to the next one. Right here, we have a high, a low. Everybody starts shorting. And keep in mind, sorry, I should have told you this, but I'm on the daily charts. So we have this outside bar and inside bar here. So price closed here and it dropped hard. This indicated to everybody to short, especially since we're at resistance. So everybody shorted. The banks recognized that and they bought, shooting price back up. Now, this was a Friday, so that's why this is an offset here. I'm just going to go over examples of it before we get into a lesson on how to trade it, so don't stress if you're not catching the strategy. I don't know why I circled that. Well, here we have an outside bar. We've got a high and a low. The next bar is in between. Trigger. Obviously, people are thinking downtrend here. So here's our inside bar. Closes here. Price starts shooting up. People start thinking reversal. So they start buying. We pass the inside bar high. So people are really thinking buy there. And then the bank short. Back down. And then the everyday trader starts shorting it as well. You can see where banks try to trick you. These long candles, they either buy or sell against us, producing these long wicks, which trick us to think the market's going to start moving up, and then they short. So the idea is to get into the head of the institutional traders. Let me see what we got here. Okay, so we've got an outside bar here. The inside bar is just slightly smaller. Price is here. It opens here. It shot up past the previous high, so people started buying. The bank started shorting. Let's move over here. We've got an outside bar here, inside. That's also a reversal candle, so a lot of traders would have recognized that anyhow and started buying. So that one, we would have looked for a false break and then a drop to short it, but we didn't get it. Here we have an outside bar, and then inside. Price closed here. It came here, shot up. People would have thought to go long here once it went past the previous high, and immediately the bank shorted, and clearly so did most day traders once they caught on. So since we're high up towards resistance, the banks made a lot of money off of the traders. So basically, think about it as we are in war with them, and they're trying to take our money. So here's another one, inside bar, or outside bar, sorry, and then inside bar. We close up here. This one, they really would have got us. Price started going up. I think from there, traders know this huge downtrend, so they shorted against with the banks. The banks saw that long wick or quick drop there, and then they bought in. Price came over here, went up. So they probably shook out some traders in that little area there. Let's see, I thought I had some more circled. Okay. And again, I'm just going over the mental process for now, and then I'll do another video on actual strategy. I just want you to get a hang of seeing these. So here we've got an outside bar, inside bar, price closed here, shot back up. Most traders would have bought there. Banks sell. Right here's an outside bar, inside bar, closed here, shot up. People would have been thinking reversal, so they bought, and the banks sell. Inside bar, currently we're forming, or sorry, keep saying it backwards. Outside bar here, potential inside bar. So if this price keeps coming down, most traders, and you're going to see people on social media posting to short this. So the next candle could open wherever this closes today and start dropping. And then I guarantee on this one the banks will buy heavy, especially since we're in a downtrend. And I'll try to update this one tomorrow just to show you what happens if we get an inside bar here. So wherever this closes today, as long as it closes above here, we're going to get a drop, and then the banks are going to buy in heavy on this one here. So tomorrow, if this candle here closes the way it is right now, tomorrow morning I would expect, say we close here today, I would expect an immediate huge drop, and that's where the everyday trader is going to short that, especially since we close with a bearish, and the banks are going to wait and they're going to buy here. So let's say tomorrow we close here. This would be people's entry. Actually, it wouldn't be because they'd wait for the market to move a little bit. So entry would be right below the previous low. Okay, so people, tomorrow it opens and it starts closing. It drops below the previous low. People have a stop loss roughly here at the open of the previous. Price is going to shoot down. Banks are going to buy in heavy here, especially since we're in a downtrend. And most people are seeing this support level, say right there. So price is going to shoot down here. Banks are going to see people that, and they're going to buy in heavy. Price is going to shoot up, take people's stop losses out, and this is going to move up. So I'm going to end that there. Go through your charts and start finding outside, inside bars, and just kind of see what price is doing. Try to get in the head of the banks. If you can do this and master this method, it is horribly powerful, and all you have to do is find these on the daily out of all the pairs in forex, and get in the head of the banker, and you're going to win. So give that some practice. I'll do another video in the near future on actual strategy on setting up your entries and stop losses and profit levels. But this is an intro to fakie patterns. That's what they're called. So I will see you in the next video.